Good afternoon, everyone. My name is Colleen Pulaski, and I'm the Director of Alumni and Constituent Engagement at the College of Nursing, and welcome to the Financial Wellness Workshop on Debt Repayment.
Good afternoon. My name is Brandon Strong. I'm the Managing Partner at Stonebridge Wealth Strategies. I'm joined with Brad Dickman, another partner at Stonebridge Wealth Strategies, and Alex Solove, who is a specialist in student loans. And today we are going to be discussing debt strategies and budgeting for nurses. So today we're going to talk about debt. We're going to define it, talk about strategies for budgeting, strategies for reducing debt, and finally student loans. So in order to understand debt, I think that we have to understand that there's two different kinds of debt out there. There's what's referred to as good debt, which is anything that is attached to an asset that should appreciate in value over time, such as a mortgage for a home, your education, business ownership, investing through an investment loan. And then there's bad debt, which is attached to an asset that is usually depreciating in value. That's a car loan, credit cards, store credit cards, cash advance, or easy pay loans. So as we move forward, we need to talk about budgeting, because there's no sense in paying off debt if you're going to continue bad habits going forward. So the first thing that you have to understand about budgeting is it should be a routine. It should be done every month or at the beginning of the year, and you should keep yourself accountable to that budget. You should make a schedule, pick dates for when you're going to pay different bills. Another good strategy is with groceries, either come to the grocery store with a list or go a set day every single week or month. And then also it's important to create a buffer or an emergency fund so that when our budget gets blown up by life, we should be able to dip into our emergency fund and not create more debt. There's a couple different methods that you can use for budgeting. Number one, an envelope method. And that's basically just putting set amounts of cash in an envelope and marking that down for that set expense, such as this is my eating out money, this is my money for going out with my friends, and so on and so forth. You should also be accountable to your budget and be able to track your progress. There's software out there that you can use, such as Mint, that will easily link into your bank account and help you track these expenses. In fact, most banks have an online program that should be able to be used to help you out with this. And then also remember your goals. We always talk to clients about what's your goal. Always start a budget with a goal in mind, and that should be kind of the carrot at the end of this progress. I'm going to pass it now over to Brad, who's going to talk about some strategies to pay off debt.
Thanks, Brandon. So if we do get ourselves into a debt situation, I'm going to go over some strategies on how we go about attacking that debt and paying that down. So first of all, if you have any credit card debt, on your credit card statement, you'll see the minimum that you have to pay, and we always want to pay more than the minimum. So this strategy here, or this example down below, basically says, hey, we have a $5,000 balance, and if we, under that situation, pay the minimum payment, that's going to take us 109 months to pay that off. Whereas if we would have just doubled the minimum payment, it's going to be paid off in a little over a year. Now, ideally, when it comes to credit cards, we want to charge something and then pay that off at the end of the month, and then we get the rewards, but we don't end up paying any interest. But again, if you do get behind, make sure you pay more than the minimum. The next strategy is what we call the debt avalanche. And basically, from a financial sense, this one makes the most sense. And we want to pay the highest interest rate first. So the one that's going to charge us the most interest, we want to pay that down first, and then proceed to the lower debts. So as an example, in the debt avalanche, basically what this is showing is we have some minimum payments, and as we attack the MasterCard at 22% and the Target at 19%, once we pay those off, we take whatever we were applying to those debts and then we put it towards the lowest debt there until we get all the debts paid off. The next strategy to pay down debt is known as the debt snowball. This one is a little bit different. Instead of paying off the one with the highest interest rate, we will pay off the lowest balance first. What that's going to do is it's going to give us that quick satisfaction saying, hey, we're accomplishing something. Or sometimes I'll use a gym analogy and I'll say, well, if you went to the gym and you lost a half pound every time you went to the gym, would you go again tomorrow? And so this strategy is going to be that same thing, where if we can pay that lowest balance off, we're going to feel good about it, and we're going to be making progress towards paying that debt off. So as an example here, you can see the Target card that you owe $500 on. Regardless of what the interest rate is, if we pay that off, we feel good about that, and then we go to the MasterCard, and then we begin, paying that one off and snowballing that. Other strategies, and I'd be real careful with all these strategies. Brandon illustrated a minute ago, to have a plan on whatever you're doing. Now, these can be very effective strategies, but you don't want to rely on these, and you want to have a plan. So it might be best to consult somebody, in regards to these, such as a balance transfer credit card. Going from a 22% to a 0% APR makes a whole lot of sense, but we don't want to play these games our entire lives. Using a home equity line of credit, from a property you own also might make sense. But again, we want to plan to just get out of debt. And then borrowing from investments or your retirement account, again, could make sense and could ease some of that pain. But again, we want to try to get out of debt, not just continue to pass it from one bucket to the next. From here, I'm going to pass it over to Alex, and Alex is going to go over student loan and student loan forgiveness.
All right, perfect. So student loans is an extremely sensitive, hot topic across the country. We could talk about this for hours on end, so we're going to try to cram it all into 10 minutes. So goals of this is, one, kind of give people some perspective on how big of an issue this really is across the country. We'll talk about that retirement and student loan epidemic. We think they go hand in hand. We'll cover 2 loan forgiveness programs. We'll go over common mistakes. We slipped in here a slide as well that provides information about retirement benefits for public employees. We think that's extremely important because if we can reduce the burden of student loans, additional retirement savings is a big thing that people use those extra funds for. We have a case study saved so we can hopefully send it out. We don't have time to cover that today, and then we'll go over a couple steps to take action. So the first slide here, we like to always include screenshots of the forms that people are using. So on the left-hand side, you see public service loan forgiveness. That is the application for if you work at a nonprofit. On the right-hand side, doesn't necessarily apply to everyone that will be viewing this. This is for teacher loan forgiveness, right? So the reason we put this in here as well is a lot of nurses work within public schools. They are not eligible for this program. All nurses working in a public school or in a nonprofit hospital, we're only going to be using public service loan forgiveness, which is the application that's on the left. So to show you guys a couple examples of this, student loan epidemic, if someone simply goes and searches student loans, you're going to find countless articles. So one of the big things that we've kind of highlighted is back when public service loan forgiveness, PSLF, came out about 10, 11 years ago, 41,000 people initially enrolled. Only 206 of them received their forgiveness after 10 years, right? So it's really unfortunate that public employees, whether it be nurses, teachers, firefighters, other municipal employees, they're applying for these programs and they're being rejected. Part of it is the program is extremely complex. Part of it is people are simply enrolling incorrectly. So the goal of us getting this information out to you is that we can hopefully bump up that forgiveness rate a little bit. All right, so to give you guys some kind of background and perspective, right now student loan debt sits at $1.6 trillion roughly across the country. Auto debt and credit card debt are at $1.2 trillion and $900 billion, right? So it's an extremely huge burden that's being placed on the workforce. So an average balance, someone who owes $50,000, they're expected to make payments as high as $600 a month. For most people, other than their mortgage, that could be the largest payment they have every month. So it's an extremely huge burden. To give you guys some perspective, we put some numbers on here. Our firm across the country in the last 2 years, we've helped over 4,000 clients with their student loans. Their average retirement savings, whether it be to a 401k, 403b, deferred comp plan, it's over $7,200. The national average is $3,000. So what that shows is clients and borrowers who address their student loans through these programs, they're able to more than double their retirement savings, which we think is extremely important. And then lastly, the big number at the bottom, $275 million, we're extremely proud of that number. That is the amount of forgiveness we have generated for those 4,000 clients. I think it comes out to about an average of $60,000. So some people are having, $5,000, $10,000 forgiven. We have some people getting over 6 figures forgiven. So this program can be very, very beneficial. All right, so what program are we talking about? So public service loan forgiveness, PSLF as you'll hear it called, is a plan for nonprofit employees. So to qualify, you must, 1, work full-time at a nonprofit, you make 10 years of income-driven payments, and then your remaining balance is forgiven tax-free. So to put that in perspective, the 3 of us work for a for-profit company. We can make payments based on our income for 25 years, and our forgiveness is taxable, right? So this program is extremely powerful. 10 years of income-driven payments, and the remaining balance is forgiven tax-free. So that forgiveness amount is going to vary from borrower to borrower. It's based on their debt-to-income ratio, and we're happy to help you run some of those numbers. So some issues with this program, this is the bad news, is 1, it's complex. A lot of people don't know this program exists, and the ones that are due, they're still enrolling incorrectly. Tax filing status is extremely important. If we're making income-driven payments, they're pulling that income from your tax return. So if someone files jointly with a spouse, it's going to lead to a higher income and a higher student loan payment. And lastly, Parent Plus loans. These are loans if someone takes for their child to go to school. They qualify for this program, but payments on them are typically higher. So we have to be very careful with those. I apologize for flying through this really quickly. So common mistakes by borrowers. I think these numbers were updated as of September 2019. 102,000 applications have been applied, and 1,900 have been approved, right? So that 99% rejection rate, it's getting a little better. We're at 98 now, but we definitely want to get more people approved. So the top 4 reasons for being rejected is 1, not on an eligible payment plan. 2, they're simply missing information on the forms. Or 3, their loans aren't eligible, right? And number 4, other, it could simply be an accounting record-keeping error or someone simply not filing their forms. All right, so we always tell people, 1, make sure you're talking to your loan servicer, talk to a financial advisor, double check, triple check. The burden of student loans is too large to simply just leave it hanging out there. All right, so we included in here real quick 2 slides about retirement benefits, IRAs, 403Bs, 457s. The goals of putting this information in here is if someone on average is saving $300-400 a month on their student loans, it gives us the ability to start saving more towards retirement, saving more for your family's month-to-month budget, as we talked about before. So we wanted to make sure we included this in here so everyone had this information. Main reason people use these plans, tax benefits, it's going to supplement Social Security or a state pension plan you may have, and a lot of them are auto payroll deducted, so it's really easy to take advantage of these plans. We'll just bypass the case study. So we encourage people to take action, leverage student loan forgiveness for financial wellness, talk to a financial advisor. Student loan forgiveness can lead to increased monthly cash flow, higher retirement contributions, and overall just relieving the burden of student loans can kind of tie back into creating a healthy and financial wellness for your family. So.
Oh, you want to go through the case?
Any questions? Awesome. So we have a couple questions from the audience. The first one is I have been investing my discretionary money into mutual funds and a Roth rather than paying off my debt more quickly. What are your thoughts on that?
So, Brad and I discussed this in the office the other day. I think it's important to, you can't make a rule of thumb for this particular situation. I think what you have to understand is what your reasonable expected rate of return might be on that investment account over time and compare that to the interest rate that you're borrowing money at. So if you have an interest rate, let's say of 6% on a debt, and you pay that off, your effective rate of return by paying that off is 6%. So if we're talking about credit cards and the interest rate is 22%, but you're saving in an investment account, it is unrealistic to to think that that investment account is going to make you 22% every single year. It might some years, but over time it won't. So I think that you have to look at the two different rates and understand that the debt you pay off, whatever that rate is, that is your rate of return for paying that debt off.
Yeah, so and to add on to that question as well, and obviously I'm going to tie it into student loans. So if you are making a Roth contribution, that is not helping you with student loans, right? So if you do have a large student loan balance, pre-tax contributions to any retirement account, it's going to lower your adjusted gross income, which could potentially lower your student loan payment. So that would be something to look at as well.
The next question we have is, how do I know if my employer qualifies me for loan forgiveness?
So to qualify for loan forgiveness for that PSLF, one, you need to be classified as full-time by your employer. So even when we deal with teachers that necessarily aren't working in the summer, they're still deemed full-time. And then lastly, you need to make sure it's simply you work for a nonprofit.
Next question. What is the best tactic for repaying student loan debt in addition to car payments, mortgage, home equity lines, etc.? If I'm able to make a small payment monthly of about $90, which one should I target?
Well, I think that goes back to some of the stuff I covered where you want to look at what your approach is and develop a plan. Whether you want to attack the smallest balance first or the highest interest rate. But I agree with what Alex said a second ago. You got to tie it into everything. So if you're applying for student loan forgiveness, that might make a difference on how you do what, in what order you're going to do.
Yeah, absolutely. And for that public service program, a lot of our clients, based on their debt to income ratio, some of them have a monthly payment of $0 for their student loans, right? That's if their income is low enough and their debt is high enough. So typically for clients, we advise running through those calculations, figuring out what your student loan payment could be based on your income. That very well could be zero or pretty low, $20 a month, leaving everything else left for your other debt.
Another question we have, what are the pros and cons of consolidating loans from federal to the private sector?
Ooh, okay. So one of the many details we didn't get to cover in this short time frame. So only federal loans qualify for federal student loan forgiveness programs. So a lot of other programs out there like Discover or SoFi, very popular for private student loan debt, that does not qualify for forgiveness. So if someone has a really small loan balance, say $5, $10, $15, maybe $20,000, it could be a great option to consolidate that federal debt to get a smaller or lower interest rate. But if someone owes a more significant balance, you'll most likely be better off pursuing the loan forgiveness program because then you can get some of that debt relieved after 10 years.
Another question we have, how many credit cards do you recommend that a person should have? If we have too many, how do you recommend lowering that number?
We were talking about this earlier. I don't see the need for having more than maybe 3 or 4. My opinion is 1, but that's probably a little bit too little. I would say, number 1, with credit cards, you need to understand how to use them responsibly. And what that means is if you're going to use them, pay that balance off on a monthly basis. The reason why credit card companies make so much money is because people do not pay that debt off and they charge exorbitant interest rates.
And to add on there, if you did open 15, 20 of them, through college or whatever, you need to be real careful about how you go about closing those, because to just close all of those will negatively impact your credit. There's a lot of articles online where they'll kind of give you the structure, but closing them slowly. But again, if you have debts, make sure they're paid off, because that good credit record of showing that you took some credit and then you paid it off is going to help that credit score.
Yeah, and just one final thing, I would also start with everyone kind of pulling a credit report first to understand where they are debt-wise. And you can do that one time a year for free.
We have another question about a 529. Do you recommend doing that? How do you go about doing that and building that into the mix?
I'll take that one. I think 529s are amazing tools for those of you that don't know what a 529 is. It works very similarly to a Roth IRA except for higher education. So you put after-tax money in and then all the growth goes tax-free if it's used for higher education. But again, I want to go back to designing an overall plan that achieves debt repayment while saving for retirement and your schooling or your kids' schooling as an overall plan. And what are you trying to achieve? Are you trying to send your child on pay for all of their college, or are you trying to pay for books, or what are you trying to achieve? And this goes back to Brandon's statement earlier. Set a goal of what you're trying to achieve and then work it backwards on how you accomplish that.
I have another question. Can you explain what a 403B or a 457 is?
Sure. So a 403B is essentially a version of a 401k for a non-for-profit entity. You're able to save on a pre-tax basis, and then the money can be removed after age 59 and a half, and you pay tax on the distribution. There's a couple other nuances to the plan. Some plans allow for a Roth contribution, but I would check with your human resources department to see if that is allowed. 457 plan then is a deferred compensation program for a government entity. That plan again is a pre-tax contribution. The big difference between the 403B and the 457 or deferred compensation plan is twofold. One, usually the 403B is easier to access while you're still employed. And then on separation from service, the 457 or deferred compensation plan does not carry a tax penalty for distribution prior to age 59 and a half, whereas a 403B does.
Yeah, and another note on those plans as well is there is no minimum to start a 403B or 457. So even someone who's just starting their career, we encourage you, no matter what, contribute something and make sure you get a plan started.
Where do I locate the loan forgiveness paperwork?
So where do you locate this loan forgiveness paperwork? There's a couple important websites to go to. Obviously, there's studentloans.gov. But more specifically, if someone's looking for very detailed information on their loans, it's nslds.ed.gov. And I'll slowly repeat that. It's nslds.ed.gov. That stands for National Student Loan Data System. It's the federal database of all student loans. All right, so by going in there, you can find all detailed information for all of your federal loans. To pull up the public service application, a simple Google search and you'll very easily find it.
Well, thank you guys so much for joining us here today. That's all of the questions that we have. If anyone joining us online has any additional questions, we have a slide here that has all of our presenters' emails. Thank you again, everyone, and have a wonderful day.